We are live, are we, Martyn? I hope that people that have attended haven't heard that. Welcome to another episode of Deal Clinic. I'm Adrian Cormican, and today we will be dancing of sorts. Dancing to find the right funding partner for your projects. Let's face it, funding is an important cog in the business of property development and property investment amongst the myriad of people that are involved in the projects. And in truth, we could probably discuss 25, 30, 40 points on the subject, but we're going to keep it under 30 minutes today, including time to answer any questions. So if there are no questions, we should finish in around 23 to 25 minutes. And speaking of questions, we would love some. Put us on the spot and we will do all we can to answer them. And there are two ways for you to ask. In the top right-hand corner, I think that way, there's a single bubble, which is private chats, and only I will see that. And there's also an icon with two bubbles, which is group chat, where we will all see it should you push the icon on the side. I'll be monitoring this throughout and will field the questions where possible and as appropriate. But please rest assured, if the webinar has ended and we haven't addressed your question, we will collect it and come back to you directly. This is the last in our latest series of 5 webinars. We will be back live again in the coming months, but we are having a short intermission. You can see all of our back catalogue on our channel, which will be below on the screen in a few moments, as well as handouts and links to LinkedIn and Instagram. And just before I hand over to Martyn, I sincerely hope you gain something from today. I've already learned something in this past month whilst we've been talking about dancing. I really don't like to dance, and I now know why. My sister picked up on LinkedIn that we were talking about dancing on this webinar, and she just asked me what it's all about. During the conversation, she mentioned that Maddie, her daughter, was now competing in Irish dancing contests. She's only 5. All the memories came flooding back when I was paraded around as a 5-year-old, a 6-year-old, 7-year-old, dare I say, maybe even 10, 11, to festivals to perform in Irish dances. Now, my mum will not be happy to hear this, but that is not my idea of fun, and I've been scarred for life of dancing. However, what is fun is funding projects, property developments, and investments. Lastly, hello to all on Instagram. Like last month, I'm testing Instagram and going live, and I'm going to leave that rolling live in the background. So come and say hello if you're on Instagram as well. Lastly, pleasure is all mine to introduce Martyn. Martyn, how are you today?
Thanks, Adrian. Hi, guys. Thanks. Good afternoon. Thanks for joining us on the latest episode of the Hallcroft Deal Clinic. Frankly, I love dancing. So, and I prefer dancing to property development, just in FYI. Also, I thought it'd be a good idea for Adrian and I to sport the Hallcroft pink for the Strictly Come Dancing episode. That was his title, not my title, by the way, and I'm actually cringing that we've got it in there. Anyway, so look, what is the Deal Clinic? The Deal Clinic is, the conception of the Deal Clinic was a bright spark idea that we would get our clients on board and we would host a sort of clinic where they come along with their problems and issues on their developments or their funding, and we would try and solve their problems. Turns out that most of our clients are actually a little bit bashful and not so forthcoming with their problems and issues, and so therefore we've decided to pull out the problems and issues that we see and try and solve them for anyone who's watching the webinar. So like Adrian said, I really do hope that you get some value out of this. I have actually 2 slides, which I'm absolutely confident you're going to learn something on, and hopefully you'll get a lot of value from that. The Deal Clinic is going to be basically 4 parts: an introduction to our business. Apologies to people who have joined us for previous episodes. I'll be going on and on about my business, our business, but it's important that we let you know what we do on a day-to-day basis. We'll jump into the Deal Clinic and we'll talk about finding the right funding partner, dance partner, as Adrian's put it, and then we'll have an open forum for questions. I said 4 parts, actually 3 parts, excuse me. So into an introduction to our business. We were founded in 2010 by Mr. Cormican. We are a 3-partner real estate finance brokerage, and we are a full service business. It just turns out that Ian, Adrian and myself have an absolute passion for development finance, and we really enjoy doing it. We also really get it. Each one of us is sat as a lender, a borrower, and as a developer, so we understand the rigors of the process from top to bottom. Recently, our business has been growing, and so we've been bringing on some additional employees and partners into the business, and we have an office in Scotland. Within the brokerage market, from our side, we feel there's really low barriers to entry, and so something that we really like to talk about is our experience to try and show people and showcase our ability to do simple and complex transactions. And hopefully you'll get a feeling of our experience through the Deal Clinic. Through the success of our business and working with really strong developers, we've also grown an unregulated mezzanine fund into our business, and that's something that we'll be talking about as we go through our Deal Clinics. And certainly if it's something you want to know more about in terms of working with us in that regard, drop us a line and we'd love to hear from you. Our team is very strong and very experienced. I'll just highlight Douglas Noble, who is our head of Hallcroft Scotland. Adrian and I are going to be up in Scotland next month, and would be delighted to meet anyone in Edinburgh or Glasgow if they have time to speak to us. We also have a non-exec chairman, Raymond Sykes, who keeps our business in the straight and narrow and gives Adrian and I a slap every now and then when we need to be put in our place. So we certainly need that. We are a full service brokerage, and I make no mistake about that. We talk about development finance today. A lot of the things that we're going to talk about today are really relevant across the product range. And so if any of the lenders are out there wondering about what sort of deals are we seeing, what is our real growth part of our business, is commercial development finance and into commercial investment as an exit. That's something we're doing quite a lot at the moment. And so if you want to speak to us about development finance, short-term debt, equity raises, please grab Adrian and I after the call or after the webinar, and we'd love to speak to you about the deal or the specific problem you have, and we'll help you solve that issue. These are the two slides that I think you'll learn the most from today, and it's something that actually we're learning about as a business: sustainable lending. Now, I will caveat this slide. We've not done any sustainable lending deals over the past 3 months. And actually, this is something that's really come to the fore over the last 3 months. And so we're hoping to get more experience by doing deals, but we understand the structure of the deals and we understand the benefits from delivering a sustainable development. Sustainable lending is backed by the government and Homes England, and it's also backed by private equity fund investment. There's a lot of private equity investors out there who can gain benefits and have a real desire to back sustainable investments. Those sustainable investments for them would potentially be investing into a platform that lends to developers that deliver sustainable lending. The structure of the lending is, if you can deliver a development that has a high EPC rating, then you stand to gain. Similarly, if you can reduce the embodied or embedded, I think, as I understand it, they're one and the same thing. If you can reduce your embedded carbon during the delivery of the development, again, you're going to benefit from that investment from your side and going that extra yard to reduce costs and delivery of materials, or have less men on site. Whatever it may be, there's a list of items we can go through. But EPC rating and lowering your embedded carbon is the way that you can achieve the best structure. And what are the benefits? Well, from my side, I think this is the most exciting thing to happen to development finance since the coronavirus business intervention loan schemes, which clearly were backed by the government. There is government incentive in relation to this for funders, banks and private equity funds. But in actual fact, if you can provide an EPC rating of A or A+, you can see up to a 2% reduction on your per annum interest rate. So if it was a 7% per annum interest rate and you were achieving a EPC rating that qualified for this, you would then be paying 5%. And similarly, if you can reduce that embedded carbon, That is calculated through the life of the development from day one to practical completion. If you can show there's a reduction in that embedded carbon, again, you're going to receive a rebate from either the government or the funder. Something we should really be targeting. We all want to live in a better place, a better planet. But if we can make it financially more attractive, then of course we're going to try and do that. Again, if you want to ask any questions about these 2 slides, let's leave it to the end. And Adrian and I are yours this afternoon to go through any of those questions you may have. So into the deal clinic, the meat and the bones of today's webinar, finding the right funding partner. I'll ask the first question to Adrian. Have you done your homework on the institution that's supporting you?
First of all, I'm not taking the claim here on choosing the title, Martyn. Dancing is not my thing, like I said, definitely yours. But let's roll with this. Have you done your homework on the institution that you're borrowing from? Look, I've been guilty of this in the past, of not doing enough homework. When I first started, you're looking for the best terms, you're looking for the best pricing, you're ignorant to what's going on behind the scenes. And that's something over the years that I've become more and more aware of, assessing who is your funding partner. So they present well. You may have only met them this year, you may have met them a number of years, but they will go through different cycles. So what sort of institutions have we got out there? Merchant banks, high street lenders, private high net worth individuals, all sorts of funds. I'll give you an example. A fund may have a 5-year cycle. You won't know that unless you ask that question. They may have an exit plan. So you've got to be very careful, because if you're coming to the end, if you're borrowing at the end of that cycle, there may be changes during your project. So make sure that part of your toolkit, when you are looking at projects, it is part of your homework. Find out as much as you can, peer-to-peer, high street, which is deposit led, high net worth individuals. Make sure you ask that question. Martyn.
I would contribute to this. I mean, look, clearly, if you're a borrower, you need to know who your funding partner is. You need to know from top to bottom how they're structured. But importantly, I think what I found over the past maybe a couple of years, especially during COVID, and even to an extent the Brexit referendum. If you cast your mind back to 2016, there were certain private equity funds, not banks so much, but certain private equity funds who stopped lending as a result of the Brexit referendum. Then if you go into 2020, March 2020, and COVID hit, there was a raft of funders who withdrew from the market. That was principally down to investor confidence dropping. And you can understand why they would want to cease lending. You can understand them having to risk assess themselves. However, if you come across a lending institution, maybe someone that's kind of new to the party, and you found that they have ceased lending for one reason or another, you want to know a cast iron guarantee or a cast iron reason why they decided to stop lending, because you don't want to be in a situation where you are in a 24-month term for a development finance facility, you're on month 13, you're well on your way to delivering your development, and in actual fact your lender pulls the funding. So for me, that's something you should really find out, and certainly should, as Adrian just said, part of your toolbox.
Yeah, and I'll lead on from that, Martyn, as well, because you touched on COVID there and how we've seen lots of behaviours and reactions during COVID, how you deal with cost overruns. I'm not going to pick on one that happened during COVID, because generally I think 9.5 out of 10 the behaviours that we've seen with our clients and the banks and the funds that we've worked with have been impeccable. Really have been so impressed. But I've casted my mind while you were talking there about a story from 5-6 years ago, dealing with cost overruns. I always describe it as, how many times do I have to have a shower after speaking to someone because they're making my life hard, they're making the life difficult. If they're making my life difficult, they're going to make the client's life difficult. And let's face it, clients have got enough on their plates without having to squirm. And I know there's processes behind the scenes and there's credit and there's problems, but that's a big one. How people have dealt with cost overruns. And generally for the people that we've worked with, I've been so impressed. But that's important, to be in your homework, go out there and find and speak to people that have borrowed, that have been in a difficult spot because of, for example, a cost overrun. How has that institution behaved?
Yeah, good point, Adrian. Totally agree with that. Finally, on this topic, I would suggest that reputation in the market is everything. There's something as an advisory business that is essential to us is our reputation. I guess every commercial entity in the UK wants to have the highest reputation possible, but be under no illusion. Within the checklist of completion, the completion checklist for any bank or any private equity fund who's lending you money, there's going to be a reputational check on you as the borrower. And what that typically will be, they'll go onto Google, they'll type in your name, they'll type in your company's name, and they'll do a news search on you and see if there's any reputational risk to them. So if you were an owner of nightclubs or something in that manner, they might think that it's too much of a reputational risk because they don't want, their investors might not want them to back you in that regard. You should be doing exactly the same thing with your funder. Now, I guess it's less important to the big banks because if you type in HSBC and you hit news, you're going to get a lot of weird reputational information coming out of that. But I would think it's more specifically related to some of the smaller bridging lenders, some of the private equity funds. And I would mention at this stage, there was a very big deal made of default rates in facility agreements, where if you did default under the facility agreement, a senior lender was, well, in some facilities had carte blanche, could put whatever interest rate on that debt they wanted. And as a result of that, there was a number of banks and institutions which had highlighted that they had a default interest rate that was higher than a credit card interest rate. So you need, if you're looking for these reputational situations, definitely do your check in your institution. Definitely check the default interest rate, and definitely do a Google search to understand who you're borrowing from. And again, this is following on from the same theme. What background checks have you completed in the bank or fund manager you're dealing with? Over to you, Adrian.
This is getting into the nitty gritty now. So you've looked at the institutions, but of course, property is a people business. Make sure you know who your bank and fund manager is. Do very similar scenarios to the institutional checks. Find out about people that have borrowed from that bank manager. Find out the people that have actually been borrowed from that person, because I think it really, really is important. And I'm going to go back to my banking days, because as a client, you sometimes won't know. You will meet someone, you'll get introduced to someone out in the market, and on face value, they can do your property investment, they can fund your property investment, they can fund your property developments. But my experience in the past has told me something different, where an asset finance person has scurried around to the property team, asked a number of questions, gone back to his desk, typed an email to his clients. More questions come, he scurries around again. The truth is, everyone wants to be involved in property, and they will chase that if it can go onto their bottom line. But that is not to the best service of yourself, because as more and more issues or questions are raised, it becomes more and more difficult to stay up to them. Now, of course, there may be a scenario where that person's going through a learning curve, but you can test if you've got experience with an appraisal by asking a number of questions on a phone call. You'll be able to work out whether they're property specialists or not. And if they're not, my view would be move on very quickly, because you're going to be part of that learning curve.
I've got a story that I think is relevant to this in terms of background checks. It kind of goes back to, it takes a step back to reputation in some respects, but there was a inheritance tax trust set up to lend on property development, bridging, and commercial investment. And this was in 2018, and they saw an opportunity to launch a peer-to-peer platform, and they named that peer-to-peer platform Choice. I won't tell you who the institution is, but I'll tell you that they called their lending platform Choice. Now, they were an extremely successful senior lender, and they reached out to a lot of the IFAs and said, we're launching this peer-to-peer platform. please speak to your clients and see if they're interested in putting potentially retail money or investor capital onto the platform to help us lend on bridging and maybe buy-to-lets as well. Just as that was launched in 2008, the Bank of England came out and said that if there's a hard Brexit, there's a potential for 35% to be written off of residential real estate in the southeast of the country, where this fund was principally located. And as a result of that, the IFAs who had this choice product at the front of their book put that choice product to the back of their book, and retail investors and investors who were going to these IFAs weren't getting the information and certainly weren't putting the money onto the platform. This business, who was looking to develop this peer-to-peer platform, had a lot of BDMs in the market, going out to speak to investors and developers, and got a swathe of inquiries. Lots of agreement in principles were put in place, and a lot of deals were in legals, and some were even agreed. Then the top managers at this inheritance tax trust looked onto the platform, looked at the balance on the platform, expecting all the retail cash and investor cash to be there from the IFAs. Where was it? Wasn't there. Bank of England had scared the market, and actually that business was unable to satisfy the agreement in principles and lend on the facilities they had agreed. Huge problem, massive reputational risk, and actually that's something. It's a bit of a war story. I think it's all really important for us to understand who we're borrowing from, who we're working with. It all sounds great coming to the market promising 100% loan to cost, 85% loan to cost, the lowest interest rate in town, lower fees. It all sounds great, but understanding who you're working with is absolutely essential. And although these stories, again, naming names is not important, but it's important that we understand these stories because these bad things do happen in the market, and you don't want to be the person holding the baby when the music stops. And this question, Adrian's one of the most humble guys I know, but I think he's actually going to give us a little bit of promotion here, which I'm on board with. Choosing the right broker. Adrian, over to you.
Yeah, Martyn does a better job of this one over the years, working with each other. But I just thought eight webinars in, it was important just to, with this type of subjects, it's quite important because this is our job at the end of the day. Our IP is to know who the right institutions are, and even more importantly who are the right lenders for your project. And it's really, really important. We got tested quite recently on this, and it was really eye-opening in the industry as to how we behave and what we're trying to drive behind the scenes, which is full transparency and trust. Like everyone will say to you, but actions will speak louder than words. And we had a scenario recently where relatively new client came to us, wanted us to do a presentation for their projects in the market, which we did. At the same time, they were running with another party in the market on another transaction. Full transparency told us, no problem with that. We'd already told the clients all the lenders that we were going to go to. The other side hadn't. They were wrapping it up in paperwork, making it difficult, leaning on their IP to try and create a scenario where it was intrigue, etc. We don't do that. I'm quite happy if a client comes to us, takes our information and is off into the sunset. They're not the right client for us. We're trying to find that right part of the market, create those relationships and create that trust so we can grow going forward. And that's what we've been doing now for 12 years. Martyn, you've probably got a very different take on this, and you've got 1.5 to 2 minutes. So fire away.
I'll probably get cut off. Well, look, at the end of the day, for the borrowers out there, for the developers and investors who would consider using a broker, I think the first thing you've got to work out is, when would you want to use a broker? When would you want to use an advisor? I mean, I guess it could be a situation where you have the conception of a deal. Could be when you've gained planning. Could be where you've got a funding partner who drops away and you've got a problem with capital and you need to fill that delta. And for me, we like to be engaged at the very beginning of a transaction. So if it's even the conception, 90% of our clients come to us to bounce ideas around, to run a simulation of an appraisal to understand how it would look from a funding perspective, because quite clearly they're going to have a very different appraisal relative to what their utopia would be. They want to know, like, for example, might have lower build costs. In relation to our funding appraisal, we're very much providing a snapshot of how the deal would look while it's funded. What's your day one equity requirement? And that's effectively, in a nutshell, what we're doing with our appraisal. Nothing more than that. You can have another 3 or 4 different appraisals that are run for investors, idea of your worst case scenario. What we're doing is giving you an idea of what your equity on day one is. So working that out very early on, I think, is essential. Also, it's all about partnerships. We pride ourselves on having the best partnerships. We spend days and weeks and years building these partnerships, and want our clients to take advantage of them. A lot of our competitors talk about how they're a market-wide advisor. I think it comes, it's an absolute given that we should know the market inside and out. So that's something that we pride ourselves on. But for us, it comes down to experience. We handle the most complex of transactions. We handle more simple transactions, but we're there from the very beginning to the very end. And it's that quality of service that separates us. So I'll leave it at that. I think it was a little bit more than a minute and a half, but I think I've said my piece.
Well done, Martyn. No, that's brilliant. I just want to keep us on time today because I really appreciate turning up and people turning up and probably eating their sandwiches as we speak. But I'm keen to get everyone away by within the half an hour. A couple of questions. Thank you again for everyone to join us. Really do appreciate it. Couple of questions. This first question, everything's in the private chat. No one's put anything in group chat today, so I'm not going to say names and let the cat out of the bag. But I've had quite a couple of questions here. Who is the best lender? That's a really hard question to answer. There is no one size fit all. There is so many good lenders out there in the market. The only way I can answer that really straight off the bat is I see a lot of people borrowing from the wrong institutions. And that's part of our job, to educate and let people know, in my opinion, there are better options. Better options, of course, depending on your specific requirements and your needs. And that's where you have to start. What are the needs of the clients and the requirements? What are the things that are important to them? And then you can fit them with 1, 2, 3, 4, 5 options and take it from there. So there's not one that I can give you. That's not avoiding the question. I can give you a list of 200 that are on our database. But of course, we work with a relatively small number of that 200, depending on the type of transaction. Can we have the slide shared? Absolutely. Sorry, I didn't turn all the downloads on at the right time earlier on in the conversation, so we missed on that. That's probably about it in terms of all general questions. So we are on 29 minutes. So from me, thank you very much. Martyn, do you want to add anything before we disappear?
No. Thanks for your time, guys. Hope you learned something, and feel free to get in touch with us in relation to sustainable lending. I'm sure it may be interesting to a number of you on the call. So get in touch and we'll go from there.
Enjoy the rest of your day. Thanks for joining us, everyone.
See you later. Thank you. Bye-bye.